Welcome to the deep dive. Today we're unlocking the latest Bitcoin on-chain market analysis report. We're looking at a price right now of around $90,585.40.
After a pretty significant correction.
A very significant correction. So our mission today is to answer one core question for you. Is this brutal drop a sign of a real structural collapse, or is it actually a healthy mid-cycle reset?
Yeah, that's the central paradox of this whole environment, isn't it?
Okay, let's unpack that.
Well, the report calls this phase a late-stage accumulation mid-cycle correction stress test.
A stress test.
Exactly. And think about it. Since we hit that all-time high near $126,000, we've seen a drawdown of just over 28%.
Right, which feels massive.
It feels massive, but here's the thing. Historically, in other cycles, these kinds of mid-cycle resets, they almost always fall into that 25 to 40% range.
So the drop itself, while painful, is kind of statistically normal.
It's right on schedule.
Okay, so if the size of the drop isn't the real story, then we have to know who is doing the selling. The report really frames this as a conflict, doesn't it? The long-term holders, the so-called smart money.
Versus the short-term holders, the speculators. It's a classic tug of war.
So who's winning?
The structural foundation is overwhelmingly favoring the smart money right now. We're just seeing incredible illiquidity.
Meaning coins are being locked away.
Tightly. Over 14 million BTC are held by these long-term holders. And these are the holders who sell into strength, not weakness. And their selling has completely subsided.
Oh, hold on. If their conviction is that high, why did we see the price drop almost 30%? I mean, doesn't that suggest some serious weakness somewhere in the market?
That's the critical distinction. It's not LTHs selling, it's speculators panicking. And when you look at valuation, any fear of a collapse seems, pretty irrational right now.
And how can we check that?
We can use a sanity check like the MVRV Z-score. It's currently sitting at 1.17.
And for context,
historic bubble tops usually push that score well above 5.0. So we're high, yes, but we are firmly in what the report calls the fair value zone. We're miles away from euphoric overheating.
And I think it's crucial that the network fundamentals are holding up too. The report mentions hash ribbons are bullish.
Right.
Which, for our listeners, means the miners, the people with huge capital investments, they're not capitulating. They're not shutting off their machines.
Exactly. It confirms we're dealing with a speculative financial shakeout, not some kind of fundamental network failure. The pain is concentrated entirely in one group.
The short-term holders.
And the ones the report nicknames the mice and foxes. They bought up about 1.2 million BTC during the rally.
And now they're completely underwater.
And that leads directly to the classic on-chain signal of a market reset.
Which is the spend output profit ratio, the SOPR, sustaining below 1.0.
Which tells us simply that STHs are realizing losses. They're selling coins for less than they paid. It's painful, but it is the necessary mechanism that resets sentiment.
But the immediate technical hurdle that's defining this whole correction is the short-term holder realized price, the STHRP.
That is the line in the sand right now.
So explain that for us. Why is dipping below that level so significant?
Think of the STHRP as the collective cost basis for all the most recent buyers.
Okay, their average entry price.
Right. And when the market price dips below it, those anxious buyers suddenly see that level as overhead resistance. They just rush to exit at break-even.
Turning every rally attempt into a new wave of selling.
Exactly. And that explains the stress we're in right now.
And this stress, when you add derivatives on top, creates that immediate downside risk we're seeing, clustered in the $89,000 to $87,000 range.
It does. It supports that idea of a final wick down to target those high leverage groups before a sustainable bottom can really form.
A final cleaning mechanism.
That's a great way to put it. But what's fascinating is we have this major macro tailwind arriving right now. The Federal Reserve is scheduled to cease quantitative tightening.
QT, yeah. Starting December 1st.
Which immediately stabilizes broad market liquidity.
So the stage is set for a reversal. What's the single strongest signal that tells us the worst of this is over?
It's one thing. A daily candle closed back above the STHRP.
Reclaiming that psychological break-even line.
Once that happens, the fuel for the next surge is already built up.
And this is where it gets really interesting. The report highlights a massive wall of cumulative short liquidation leverage sitting right above the $95,000 to $105,000 zone.
A huge wall. So reclaiming the STHRP will trigger those highly leveraged groups, the mice and foxes who are now shorting, to initiate forced buy-ins. a short squeeze.
And then the big money follows.
And the rhinos, the trend followers, confirm the move with large buy orders, and they use that short wall as fuel for a rapid markup phase.
So let's bring it all home. What does this all mean for you? The fundamentals here remain overwhelmingly bullish. This painful flush out is healthy, it's resetting sentiment, removing the weak hands, and it's basically laying the foundation for a pretty explosive recovery.
And that really raises one final provocative question. How small is this correction in the grand scheme?
Go on.
If you look at the long-term power law analysis, the current price, near $90,000, is still well above the long-term support line, which sits closer to $50,000.
But we're still far above the historical floor.
Far above it. And on the flip side, that same structural analysis gives an implied recovery ceiling up near $500,000. So while the stress test is definitely stressful, you are simply witnessing a necessary pause within a massive, ongoing long-term trend.